Good afternoon and welcome to BizTech's ASEAN Midday Market Watch. Our guest today is Gabriel Yap, Executive Chairman of CGP Global. Gabriel, happy Chap Gourmet and good to have you on the show.
Happy Chap Gourmet, Brian.
Now, Gabriel, before I get your insights, let's take a look regionally and see how markets have been performing this morning. Now, we start off with Bursa Malaysia, which is down 0.24% at 1,577.16. The SGX is down 0.98% at 2,944.33. Now, across the region, we've got the Nikkei, which is down 0.94% at 29,281.37. So very sharp decline. Shanghai Composite is also sharply down at 1.84% decline at 3,519.09. The Hang Seng is down 2.43% at 29,342.49. ASX 200 is down 1.88% at 6,704. And rounding off, we've got the Kospi, which is down 3.26% at 2,998.69. So, Gabriel, what's your view on this sea of red across markets?
Well, Brian, I think beginning this week, this sea of red, it is actually triggered very much by the rise in the 10-year bond yield in the US. As you noticed, yesterday it crossed for the very first time since the COVID-19 pandemic started above the benchmark 1.5%. So the market participants are fearing that it will come close to the 2% level. This would mean that from the pandemic low, we have already seen bond yield actually climb from 0.65% thereabouts to currently 1.5%. This is not abnormal, Brian, because way back in 2018, bond yields in the US also did climb by close to 100 basis points, and that initially caused topsy-turviness in markets. But if history is any indication, the key thing is that this will present a good buying opportunities. And what happened in 2018 was the fact that the markets normally, after getting ahead of itself, they will pull back. They need to find a reason to pull back. And the rise in the 10-year bond yield is a very good reason for them to actually be taking profits there after a strong run in December as well as in January.
Now, Gabriel, one of the challenges and the worries that are unnerving investors is really the fact that the rise in rates is really driven by inflation rather than economic recovery. Now, how is that going to impact us in Asia?
This is debatable, Brian, because if we do not have a strong economic recovery, then that will actually not fuel inflation. Now, inflation cannot just come about because of poor economic growth. In the history of economics, that doesn't work. See, so the key thing is that if we are actually getting out of the rut that was caused by COVID-19 pandemic last year. This year's comparison, because last year comparison numbers would actually be on a low base. So if it's a huge number, be it GDP growth as well as actually other income factor numbers, and you're comparing to last year and you get a big jump, I mean, it is not quite correct to then surmise that because of the big jump, it will then cause inflation or inflation fears will come in. But generally, that's how the market works out. And so for the smart investors, you will note that unless this jump is too drastic and occurs in too short a period of time, then this is something that's valid. But if it's actually not and it's done over a gradual process, as what you saw in 2018, then this will actually pass.
Now, Gabriel, you talked about being a smart investor. Now, is this pullback now giving you some opportunities to accumulate stocks?
Oh yes, Brian, I'm actually having a field day today because the stocks that we were recommending in our investment classes actually skyrocketed, after a strong performance in December and January. As a comparison, for example, some of the stocks, that's the tech stocks trading in Hong Kong, surged by as much as 30% in the last 2 months. So today, some of them are actually pulling back very nicely. So some of the names, for example, like Tencent, we really recommended it. It was at 510. The stock went from 560 to 750, within 2 months in December and January this year. So right now it's having a good pullback, and it's really a good opportunity in this instance.
And Gabriel, I'd like to remind you actually that you made those recommendations on on the Midday Market Watch, and in fact, some of those were made on our Christmas Eve show, which really then I think we did an analysis, and that really showed a very steep rise, the steep rise that you were talking about. Now, coming back to something perhaps a little bit safer, low interest rates, obviously, and right now we've got abundance of liquidity. Now, that's really enables some of the REITs to conduct some yield acquisitive acquisitions. Now, that's going to help to boost distribution per unit. Which REITs are you looking to accumulate given this pullback?
Well, I would be wary of those REITs that are just raising money for acquisitive purposes, where the underlying yield as well as actually the assets are actually questionable in terms of quality. So in this regard, I actually like to stick to the big industrial REITs. So some of the names that we have mentioned in our classes is Ascendas REIT, as well as actually Maple3 Logistics Trust. So take the case of Ascendas REIT. Last year they raised already 1.12 billion thereabouts, and they have set aside something like 650 million US to complete the acquisition of its proposed European data center assets. First and foremost, the data center assets are actually something that would hold pride in many industrial portfolios for many of the REITs right now. So if the parallels that you have in the US, like the Equinix, the DLR, they have done very well. So having these assets within your current asset portfolio will actually stand out very well, because if you looked at the performance of MIT Maple3 Industrial Trust, they have actually now segregated data center as a separate asset. The stock has been one of the most resilient and outperforming because of this data center class. And then secondly, if you look at the discipline of Ascendas REIT in making all acquisitions in the past few years, in fact, they are one of the oldest REIT having listed in Singapore since 2002. So it's like 19-year birthday for them this year. It's like, they have done acquisitions with discipline, which allows them to continue to have yield accretive assets. So we expect that essentially going forward, it's one of the REIT that will continue to be able to deliver, in terms of earnings, in terms of the quality of assets, in terms of the type of assets as well. So these are the few things that investors should be looking out for.
Now, thank you very much for coming on the show on this Chuck Gourmet day, Gabriel.
Happy New Year to you and your viewers.
Yeah, we've been speaking to Gabriel Yap, Executive Chairman of GCP Global, on the ASEAN Midday Market Watch. I'm Brian Fernandez. Check out www.biztech.asia for business and technology conversation.